Let's move to another transactional group that I'm not exactly sure if you learned this in the first summer session or the second summer session, but let's think about investment securities. Now, if we had an investment security that was an equity, how do we handle equity securities from an accounting standpoint? Well, assuming we're using a cost basis and we're not using the equity method, or this is not a consolidated entity, right? So we're looking at equity securities where we do not have substantial control or substantial influence, right? So it's likely we own less than 20% of the organization, and if we do own less than 20%, we don't have a lot of board representation that would suggest that we have a lot of influence. So we're talking about not equity method accounting and clearly not consolidation accounting. So we're talking about that investment. So how do we account for those equity securities, right? Well, if you recall, they're at fair value with changes in fair value going to the income statement. So if we ended up having a equity security that was purchased and it is in a foreign currency, right? So we had to go out and buy it, and it trades not in the U.S. market, but it trades in a foreign exchange. It trades in a euro market, or it trades in the Hong Kong market, et cetera, but it's not trading using US dollars. Then when we do the fair value calculation, not only are we dealing with fair value changes due to the entity, but we're also likely dealing with fair value changes related to any FX differences. So the fair value of both of these items is captured here, and it's already going through the income statement. So for equity securities, there's not a separate FX transaction because everything's at fair value anyway. So now we have to start thinking about, well, are there other investment securities that are not handled this way, right? Well, what are the other types of investment securities that we could have? Well, we could have fixed income or debt securities, which are purchased in a foreign currency, right? We had to go buy we spend X number of euros to buy this particular euro security, and we will get paid back, not in dollars, we'll get paid back in euros for the debt security. And any of the interest payments will also get paid back in euros. If we buy a debt security where all of the return of capital and any of the interest comes back to us in US dollars, then we don't have an FX issue. But we're setting this up that this is a foreign denominated debt security that is going to have future payments in that foreign currency. So, how do we handle debt securities? Well, it depends on which portfolio you're looking at. Right? And we had 3 portfolios that you learned in your previous course. We had trading, we had held to maturity, and we had available for sale. Now, trading securities, that's easy, right? That has the same accounting as your equity securities. Fair value, change in fair value go through the income statement. Held to maturity is a disclosure of fair value. But we also have an FX issue. So we're going to have to determine, since it's held to maturity, we're going to have to determine, well, what is the FX change for that held to maturity security? Sorry, I had to pause that for a second. So as I said, our held to maturity portfolio, if the security, again, this all comes down to if the security is not in our functional currency, right? Yeah, we've got to disclose the fair value, but we're still going to have foreign exchange adjustments. Now, we don't have to book the fair value foreign exchange adjustment. We just need to, given the current rate, the current exchange rate, so if we were dealing with June 30, we'd look for the current exchange rate, and we would have to update what was the value of that held to maturity security given the current FX rate. All right? Again, foreign denominated held to maturity security. Well, how do we account for available for sale securities? Well, available for sale securities are fair value, changes in fair value go to OCI. So any of the FX piece, any of the market driven piece, say it's interest rate driven and FX driven, that fair value is going to show up in OCI. However, if any of this fair value change is related to credit losses, and if there are potential credit losses even in your held to maturity securities, credit losses have to be recognized as a reserve, just like you would with the allowance for doubtful accounts. It's a potential credit loss. Those credit losses have to be recognized in income, likely through some kind of a reserve related to these available for sale and held to maturity securities. Now, none of this should be new to you. This all should have been discussed either last and during this should have been discussed sometime during the summer. All right? If there's issues with this, then we should go to the literature, we should go to the professional literature and make sure that we're comfortable with what we should be evaluating. So if we're looking at foreign currency and we're looking at what ultimately gets recognized subsequently, we can look at subsequent measurement and we can see available for sale debt securities, that the change, it says right here, the entire change in the fair value of foreign currency denominated available securities should be reported in other comprehensive income, but the transitional guidance talks about we need an allowance for credit losses, right? And we need an allowance for credit losses, right? So for available for sale securities, it's all going to go to OCI except for credit losses, and that also that's any kind of fair value change, whether it is market changes in interest rates or if it's an FX issue.